Yeah, well, so in terms of background, I joined Fidelity in 1990, which seems a very long time ago, as an analyst, an investment analyst, covering the retail sector on a pan-European basis. Then became a fund manager running UK funds in the equity income sector. Spent a short time at M&G in both a sort of portfolio management and man management capacity. Returned to Fidelity in 2004 and running UK funds, and then switched to running continental European money, these funds of Fidelity European Trust, a little bit more than a decade ago.
Yeah, I joined Fidelity in 2014 as an analyst, covering initially tech and then moving on to industrial sectors. And in 2020, I got promoted to portfolio manager to work alongside Sam on the Fidelity European Trust and the Fidelity European Open-Ended Vehicle. We typically talk about co-PM as being similar to a co-pilot role. So my job is to make sure that the plane is flying in the optimal slipstreams, in the safest, best possible route. But at the end of the day, when, and I say when, not if, Sam and I have a disagreement, he's the one with the hand on the wheel and he's the one with the final decision.
Well, like many others in the peer group, we are stock pickers, but perhaps what differentiates us is our focus on dividend growth. We strongly believe that companies that have dividend growth will outperform consistently over time, and there's a lot of evidence to demonstrate that. We think it is a robust indicator of a healthy company, and we think that dividend policies are leading indicators rather than lagging indicators. If a management or a board are not growing the dividend, I think that's telling you something about how they see the prospects for their company, probably not good. So really, Marcel and I spend a lot of our time trying to identify which companies will be able to grow their dividends over the next 3 to 5 years, and then making sure that we're not paying too much for that dividend growth. We have 4 key criteria that we look for in companies. Number one, positive fundamentals. We're looking for companies that are proven business models that generate good cash returns on cash invested. We like to invest in companies that generate cash. Obviously, you can borrow to pay a dividend, but generally there's quite a strong relationship between good cash generation and a good track record in terms of dividend growth. And also, we prefer to invest in companies with strong balance sheets. We certainly don't want to be invested in any company where the financial leverage could potentially jeopardize the ability of that company to grow its dividend going forwards if times were to become a little bit more difficult. And finally, and very importantly, valuation is critical to us. We do prefer to invest in companies where that dividend growth is not already discounted. So it is all about dividend growth at a reasonable price or hopefully an attractive valuation.
Yeah, typically it really starts with the analyst. We have a fantastic bench at Fidelity of really talented analysts, and usually it will be one of our analysts who have found an idea, could be a new idea or could be an existing stock that they found a new piece of information of or a new way to look at it. And the analyst will then bring it to Sam and I and ask us to kind of see if it meets our screening criteria, if it could be a stock that meets the criteria necessary for us to invest in our funds. At that point, we'll typically do a lot more work on the stock, including meeting management a few times. And if we like what we see, we'll then buy it. Typical holding period is around 5 years, although there's a big range and there's a big caveat here. Perhaps the best example is Nestle, which has been in the trust for 30 years since its inception, which is an example at the extreme end, but not entirely unusual.
Well, our objective in terms of performance is to outperform the benchmark steadily. We're aiming for outperformance of 1 to 2% per annum post fees. We're not really trying to shoot the lights out. We think in the long term, investors will be very happy with that sort of performance. And certainly, the vast majority of peers tend to underperform the benchmark over the long term. So that will lead to good performance relative to peers as well. I'm pleased to say that we've achieved that objective on a 1, a 3 and a 5-year basis, and actually since the tenure of the trust as well. And that's on an unlevered basis. So including the gearing, we're actually a little bit above 2.5% outperformance post fees per annum.
Given our focus on dividend growers, we tend to outperform when growth is outperforming value. Conversely, when interest rates or inflation expectations are rising, we tend to underperform. Lastly, given our focus on downside protection, we tend to run the fund on an unlevered beta of less than 1, which means that we will outperform more when markets are falling than rising. Lastly, I think it's important to state that we are at heart bottom-up stock pickers, so over the medium term, we'd hope to outperform any sorts of market conditions.